Greetings. My name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit GPC, here with your April 2026 investment strategy update. Okay, so before we get started, I'm delighted to share with you that we have just received India's Best Chief Investment Office Award from Euromoney for 2026, and also India's Best for Alternative Investments in 2026. It's certainly an honor for us to be recognized. Now, coming back to the investments last month, we had recommended in our March commentary investment outlook stagger buy on equities, and we upped our allocation to equities, and we stated our preference for mid and small cap for growth investors, and for conservative investors, large caps. And we've updated our timeline. Please do check this out. It's in the commentary. It's the calls we've made over the last 6 years. Now, coming to our outlook for this month, we usually start with our outlook on U.S. and emerging markets. For U.S. markets, in particular, the war, we find that there's some striking similarities between the reasons for the war, the reasons for the oil spike, the conflict between the Fed chair and the president on interest rates, inflation, a weaker dollar, unemployment, lots of similarities. And so when they say history rhymes, it certainly is true. Please do check that out. There's more detail in the commentary. And we also touch upon the structural changes that we're witnessing in the geopolitical space. Things are changing that have held for over 80 years, and supply chains are being restructured, new trade relationships, and the opportunities that will come up as a result of these changes is something we also take a look at. Now, coming to markets, as we anticipated, bottomed and have shot up aggressively, rapidly to new highs, both in the US, EM, and India. And India not to new highs, but I think the salient point is that there is a Trump put that is in place, and it's related to both equities and bonds. When the 10-year approaches 4.5, that typically is an area where the president has generally stepped back and on his policies, and also on equities typically seems like a 10% correction. So we've got a Trump put. We also would note that the markets continue to be driven by AI capex, which is now up to 49 billion a month, which annualizes to about 600 billion, which is largely the hyperscalers. And so the US is largely being driven by AI capex, 600 billion, up 5x from 2020. And we're witnessing EPS estimate revisions to the upside. We're witnessing a broadening of the rally. And that is the other leg on which the U.S. economy has been, and U.S. markets have been holding up, is the bullish performance by the equity markets. That bullish performance has also extended to markets like Korea and Taiwan, which are also benefiting in large part from U.S.-driven AI capex. Now, some data to suggest what we spoke about earlier. This bottom chart here is signals that have occurred over the last 45, 50 years, where markets have rapidly accelerated from bottoms. In this case, some 12.5% and some roughly 17 odd days. And that signal has only occurred at major bottoms: the 74 bottom, the 82 bottom, the 87 bottom, the NASDAQ bubble, a false reading at the 2007 peak, the grand financial crisis, and COVID, and now. So that certainly gives us additional comfort, in addition to all the data that we shared with you last month, that the rally of the lows seems to be a legitimate rally off of a market bottom. Now, the other thing that's anecdotal and interesting is that most market bottoms appear to occur in March. It's March 2003, March 2009, apology for the typo, February 2016, March 2020, March 2023, March 2025, and now March 2026. It's interesting. Not much value in that data other than to note that it's interesting. Additional couple of data points. This is the deviation from the analyst consensus estimate. And when that deviation of the price of the index from the analyst estimate widens, it typically happens around market bottom. So this is for the Nifty and for the mid caps. And if you look at the data, it suggests that we're approaching again levels that have historically corresponded to market bottoms. Now, looking at the environment and in the title of our commentary, Investing Strategy in Times of Uncertainty, we certainly have the AI capex that is going to hold up for all as far as we can see. We also have a tremendous amount of momentum in the energy space. Countries really recognizing that they will need to reduce their dependence on the oil driven dependence on the Middle East, and are rapidly those that can are rapidly transitioning, including India, into green energy, into securing commodities, supply chain access, and also the second trend that looks set to accelerate or is continuing to do well is defense. And so we've already seen the government of India announce a 7.9 crore, 7.9 lakh crore, my apologies, investment commitment into the energy space. So we anticipate the infrastructure investments in that space will accelerate and drive economic momentum. Also, for precious metals, we think the bull run will resume at some point. We remain in a consolidation pattern with marginal downside. Mostly what we're seeing is metals cycle through their technical extensions and are now setting up for a bull run at some point in the coming months. In terms of portfolio construction, we continue to believe diversification into investments that have earnings visibility, well-researched, driven by sectoral or thematic tailwinds, and non-correlated is the ideal way to create a portfolio. And that's largely or exactly what we have been recommending to you over the last few months. That's it from my side. Thanks for watching, and I look forward to seeing you next month. Thank you. Bye-bye.